Welcome to our next panel on portfolio funding. So again, this is an area with a lot of interest from both funders and those who are seeking funding into this space. And I will let the panel introduce themselves in a minute. We wanted to talk about various financing options and different trends that occur in this space. So, Alex, do you want to introduce
Introductions? Yeah, sure. Hello, I'm Alex Garnier. I'm a founding partner at North Wall Capital. North Wall Capital is a special situations credit fund with a number of strategies, including legal assets. We have around 1.2 billion under management today, and we're growing fast. We also have a series of legal assets funds. The first two of those are fully deployed. The process of raising a third fund. Very happy to be here today. Thank you for the invitation.
I'm Leeor Cohen. I'm part of the Burford Capital London investment team. Burford Capital, for those who don't know, is a more traditional litigation finance firm. And again, thank you for the invitation. I'm very happy to be here.
I'm Tom Steindler, Managing Director of Exton Advisors, which is a specialist advisory firm in the litigation finance space.
Hi, I'm Chris Neill, Partner and Global Legal Services Director at Pogust Goodhead. We're a law firm acting on behalf of claimants in group claims. We entered the market approximately 4 years ago and now represent over 2.5 million clients worldwide.
Excellent. So we have here a law firm, two different funders and Exton advisors who are sort of overseeing the market. And I first wanted to ask my question to the funders, Alex and Leo, just to talk about portfolios in general. What type of portfolio deals you're looking at, given your investment criteria internally? How do you structure and diversify those portfolios? And also, when we're talking about financing to a law firm, is it for you financing given as a credit line to a law firm? Are you talking about equity investments, or is it funding specific cases? What is sort of which cases you find more attractive?
Do you want to start?
Very, very happy to. I think there are different ways to have exposure to a portfolio. Obviously, you could fund case by case. You could acquire a portfolio, or you could fund a law firm or a platform that already has a portfolio and will continue to build that portfolio. I think the answer to your first question, it's important to just remind you of our perspective as a credit investor, and that is downside protection as far as possible. This is not a typical credit investment, of course. There are binary risks involved. Asymmetric risk reward, diversification, lack of correlation between the underlying risks as amongst themselves with our portfolio and with the market, the macro market more generally. And so what we would typically prefer is a credit instrument, a loan to a law firm. We would want there to be limited scaling risk because book building is a big risk, and you can end up deploying a substantial amount of capital to set something up, only not to recover that as time goes by. We would look for alignment, which is a little bit easier with a credit instrument because you have a principle that there's a deployment of capital, of debt, which has to be repaid before the parties share in the returns. We would look for diversification, as I mentioned earlier. So the broader the range of risks, the better. Different types of cases, different jurisdictions, different defendants. We would look for ways to mitigate duration risk as well. So ideally, you'd have a situation where there are a number of cases that are close to settlement, especially if there are other cases that are very far from settlement. And then, of course, there are the typical aspects you would look for in any litigation financing type transaction, which is to have comfort on settlement or a judgment as far as possible, to have comfort on the damages and all the legal fees, depending on what you're participating in, comfort on the costs you have to expend before you get there, and some level of comfort on the duration. So it's a mix of many different factors in order to minimize your risk, improve your downside protection in the event any one of those cases goes wrong, and you have to really assume that many of those will, for a variety of idiosyncratic reasons, some of them known in advance and some of them not, and to try and ensure that you're working together with a law firm in a structure which incentivizes both parties. Just one other thing I will mention on incentives. I think we do individual litigation financings, but the issue with that structure is that theoretically, at least, your counterparty, the law firm, is incentivized to run up costs, particularly if they're being paid 100 or 70 or whatever percentage points of the costs involved. Whereas with a financing of a law firm, you can try and get around that by making sure that you all make money together at the end of the day, rather than as you're progressing the cases.
Thank you. And just before Leeor, you comment on this question as well, just to follow up from the previous panel, when you raise money into your fund, Alex, and I know you do fundraising into litigation funding as well as your other asset classes, do you find one is more difficult than another, or different, or the requirements of your LPs and your investors are different when you raise money into litigation funding as opposed to other asset classes?
Yes, there are certain investors, we have investors who are pension funds, insurance companies, multifamily offices, investment banks. I think they all have different perspectives on this. For many, litigation funding is a big no because of the binary risk element, and also because of the duration risk. It's also a relatively novel asset class, even in the UK. So you have to try and mitigate for many of those factors. I think you have to be honest that on an individual litigation financing, you could lose all of your money. And I think you have to be honest that the mitigants I've talked about with a portfolio, diversifying your risk, all of those things are helpful, but they may not they may not protect you in every scenario. The things you can do to mitigate duration, for example, is to try and construct something which you can liquidate. Try and make sure that you're in a situation where liability is proven or pretty much proven. So really, you're just working towards a settlement with a counterparty, and it's a question of quantum and a question of when.
Thank you. Leeor?
Maybe before we start, I think it's important to just identify what kind of portfolio we're talking about, what kind of risk. Burford does a lot of type of investments into law firms in conjunction with law firms, and so to speak. But the important thing is whose risk you're, so to speak, taking off. In some cases, the law firm is acting on a contingency basis, in which case you're taking the law firm's risk, or you're de-risking the law firms. In other cases, you're de-risking the law firm's client's risk, where the law firm continues to earn fees for its partners and associates services. Those are not the same, and they do not offer the same protection for the funder. One can be cross-collateralized. So if a law firm is willing to put its contingency book as collateral, that contingency book as a whole secures, so to speak, your entire investment. But if the investment is really a portfolio of cases run by a law firm, and the law firm itself is acting on partial risk or no risk at all, then the risk is really the claimant's risk. And that risk doesn't cross-collateralize other risk, because the claimants will never agree to that. So a lot of times the word portfolio is thrown in, and it means different things to different people. But I think in an effort to reduce the cost of the capital and make the product more accessible, once you can construct a portfolio that provides some sort of risk mitigation by way of cross-collateralizing or over-collateralizing, that is very helpful. We were fortunate enough as a firm to do things that are even more novel or kind of, so to speak, unique in the sense of buying into law firm equities and other structures that are somewhat different. All of those are opportunities. I think the important question is always, what is the risk that you're trying to mitigate? What is the problem you're solving in terms of financing or otherwise? But, and again, as Alex mentioned, and I couldn't agree more, the important thing at the end of the day is the quality of the legal assets that are backing your investment, right? I mean, a portfolio is not worth more than what's in the portfolio. So if the litigation itself is meritorious and it's against parties that can, at the end of the day, pay, if so instructed, that's a worthy collateral. So I think, not to replicate panels before us, but a lot of what we look for is the same as what people look for in single case litigation. Is the case meritorious? Can we recover? Obviously, how long will it take, which is a huge problem for everybody involved, both from a duration perspective, but also from a collateral perspective. All of those factors, so to speak, are weighed in when we make a portfolio or law firm financing investment.
Thank you. And Chris, now from the point of view of a law firm, if you can comment a little bit on the, how you approach fundraising from a law firm, how you source funding for your cases, and maybe commenting also just your experience in general in the market, not just PG, but in general, what are sort of the challenges that are facing, that the law firms face when they go into the market to raise money?
Perfect. I think the starting point, cost of capital is key. We want to reduce that to ensure that that benefits the firm, our staff, and most importantly the clients, and we can pass that on. So I think that's the sort of starting point. But this will be specific, say, to PG, which is we always knew that we wanted accelerated growth. Our growth plan from day one was quite clear. And so for us, when we looked at who we wanted to strategically partner with, it had to be a fund that could commit to the level of funding, either or multiple funders, to what we set out to achieve. And they had to be agile in quite a novel area in terms of the volume of clients that we wanted to represent too. And so for us, it was more about strategic alignment, and that was our key factor in deciding who to fund with. And there were some funders that we decided that actually we didn't feel the synergy was there in our growth period. So the starting point is speed. We do early diligence on all of our cases. The cases that we like we are a claimant firm. We like cases which have scalability, where we can impact the many clients that we feel that otherwise wouldn't have access to justice or a route to redress. And so when we look at our cases, we do a lot of early diligence because the stakes are high on the litigations that we like to pursue. And so that sort of comes back to sort of which funder you want to partner with. If we feel that we are diligencing at such a high level in the early phase of the case, we kind of want speed in decision making from the funder aspect too, because some of the panelists have commented that the amount of deals that come across the table, which they ultimately reject, but you're typically as a law firm under exclusivity when you are having those conversations. So we know the sort of cases that we like to bring, which have a real clear ESG message, which really come back to the heart of what our business aims to do globally from a sort of ethical standpoint, and what our cultural sort of modus operandi is. So for me, it's that position of we're quite a unique business. So if you look at group claimers in the UK market, historically they wouldn't have the volume and scalability that we now see, and so that we from day one had that mindset. Now, that's our business case, but there'll be many other law firms out there where individual case funding is specific and actually more sort of suitable method of funding for their model. But I suppose we've found a sweet spot in that we don't just limit ourselves to portfolio, we take the best of both on a case-by-case basis. So for our story is quite unique, but hopefully that sort of...
And would you say among different class actions, are any class actions that are easier to sort of fund or find funding for? Talking about opt-in, CAT, and general.
Yeah, I suppose if we sort of pull back to portfolio funding, there might be cases within our portfolio that might not be as attractive to a funder if we present it individually, but when you look across the portfolio, it's actually it's a good case. It might be a good case for reasons that are just outside of the commercial sphere in terms of return, but the other cases that you seek to bring can carry some of those cases, and it's just the right thing to do. So from my perspective, like the portfolio aspect means that we can probably extend the services that we provide in a broader fashion to really come back to the sort of basis of we want to provide access to justice for clients. And so portfolio funding has been great in some regards on those cases. They are going to be profitable, but maybe not so much as some of the other bigger claims that fall within the bucket. I think when you spread out the number of cases that you have within a portfolio, we've had the other panelists earlier on today talking about duration is key. But if you have some really large cases in there which you expect to mature earlier, then they can carry the weight of the portfolio and de-risk and be quite an attractive proposition. When we speak to Alex or and our other strategic partners.
And Tom, so you're obviously seeing a lot of deals in the market that are being funded, those that are not being funded or they didn't manage to get funding. So if you can comment, please, on the structures to the extent possible on deal terms and pricing, and sort of what are the challenges when you're being tasked with finding funding for deals.
Sure. So I think as Leeor alluded to, portfolio funding as a concept covers quite a wide variety of sins. It means different things to different people. And so naturally there's quite a variety of different deal structures and types. And I think whether a portfolio deal is possible and the type of structure that you should look to, what's appropriate, really depends on the answer to a few key questions. Whether you're looking at an open portfolio in the sense of a forward flow of deals, or whether it's a closed portfolio in the sense that you are looking at a discrete number of identified cases, who the borrower is and whether you're financing a law firm or whether you're financing one or more claimants and the different cash flows that are and risks that are associated with that. And alongside that, the use of capital. So whether you're solely looking at financing case expenses, legal fees and disbursements, or whether in the case of some law firm financing, there's elements of ops financing or launch capital. And then finally, the kind of repayment of proceeds. So allied to that is whether repayment comes solely from the proceeds of one or more case outcomes, or whether there's a wider collateral pool and security, which means you can look to different instruments. And so, perhaps unsurprisingly, on one end of the spectrum, you have, I think, portfolio deals done which don't, when it really boils down to it, look very different to a single case financing. Often those structures still rely on multiples of deployed or committed capital, percentages of damages. And there may or may not be some pricing advantages to look into a portfolio, depending on the composition of that portfolio, whether there's cross-collateralization and things like that. In the middle, I think we are seeing greater use of credit instruments. Revolving credit facilities are now quite commonly used by law firms, particularly at what we might call the consumer end of the market, places like Plevin, high volume, lower value. Revolving credit is commonly used there, and I think we're seeing that more in the commercial end of the market. We're seeing law firms look to credit as a way of achieving growth capital. Often a couple of percentage points a month, and but different structures there. And then finally, I think on the law firm financing side, what we at Exton would kind of consider to be slightly more pure play corporate finance, we are seeing more equity stakes being taken by funders. A lot of law firm launches with convertible debt, for example, which really opens up quite an exciting universe of potential. And so it really does depend on the deal. As for challenges, there are a few. I think the first is really identifying deals. This isn't a space where there is a huge amount of deal flow, and not every circumstance where there are multiple cases is it appropriate to structure as a portfolio. Even circumstances where there are a law firm with multiple cases doesn't necessarily mean they can be corralled neatly into a portfolio. So finding the right incentive structure and deal is difficult. And when you do, they are quite bespoke to structure. That's the reality of it. The other is, I think, stepping back a few years, we saw quite a lot of sort of informal portfolios, relationship agreements where you were looking at a kind of forward flow of cases and not necessarily kind of financing it. They weren't necessarily seeded with cases. It was more of a sort of forward-looking relationship, and getting alignment right. Issues of discretion and things like that do make those deals quite challenging in my experience.
Mm-hmm. And just to follow up with your equity investment point, maybe if you can just elaborate and say with the other panelists on sort of the deal structures you've seen. Have we seen this a lot? Maybe in Europe as well. If anyone sort of has come across this, because this was one of the questions that we were discussing with the audience as well.
Yes, as an example I gave, I think we've seen launches of new disputes boutiques that are debt financed, and that may or may not convert to equity. I think Leeor might want to jump in with some public examples where Burford's taken equity.
Yeah, and Burford took equity essentially as a capital solution. It's not a strategic relationship. It's more of a capital solution. If a law firm or a partnership is in a position where they need capital, and the only way to raise that capital is by way of issuing equity, we're more than happy to take the equity. It's a business case like anything else. We don't interfere or contribute. You can decide on how you want to look at it, but we don't interfere or contribute to the running of the firm as much as we are a passive investor. If you are setting yourself up as a firm under an alternative business structure, you can issue equity to non-lawyers, and it is a very easy way for a law firm to raise a large amount of capital needed for strategic changes or other changes or personnel changes that is necessary in a particular point in time, where alternative financing is most likely non-available. It's very hard to go to a commercial bank and ask to borrow money in order to make strategic changes in a law firm. That's usually not available. And the two ways that Tom alluded to are either an equity stake, which you so to speak sell out or issue out, or so to speak a seeding facility. I'm not sure how you call it, I'm not sure it has a name, but it is essentially an initial loan to the founding partners to allow them to grow their business for the so to speak the short duration until the firm is up and running and is able to generate some cash flow. It's obviously both are obviously very risky and very expensive, but it does open up doors and open up possibilities for law firms that otherwise would not have the access to the capital.
Yeah, I think we also need to be sort of careful with nomenclature. I was having a conversation outside of the litigation financing context with some venture capitalists the other day, and they were talking about how it was a very important principle that the founders and management team of this company should not be in the preference part of the capital stack. Really what they meant was the external investors should get paid first, and the founders, the management team, should be incentivized to pay back external investors before they get rich, simply put. And I think whether it's debt or equity or litigation financing, the principles I talked about earlier around alignment of interest are probably the most important ones. I think I agree with Leeor that there is an ability to take more risk if the upside is greater in a quote unquote equity like structure, whether it's actually shares in a limited company or a GP stake or something else.
I mean, I couldn't agree more. At the end of the day, all the external financing that comes, I mean, we all say it's either debt or equity, and it's really on the borderline, because even the debt looks somewhat...
Even the debt is, 2x or,
Yeah,
plus,
it looks like equity,
right?
almost.
So, yeah.
Yeah, I mean, it's not, a loan from HSBC. So it's very expensive debt. It looks almost quasi-equity. And it's, so to speak, last money in, first money out. It is risk capital. It needs to be paid first. And it does create an incentive for everybody to make sure that that they're working for a combined goal of getting the financing party paid for the financing, and obviously making it very attractive and hopefully profitable for the partnership.
Yeah, and look, it makes sense to do that in order to fund cases that may not otherwise be fundable at that stage. As Chris mentioned, start new business lines, hire new people, open new offices. All of these things are very difficult to underwrite from a debt perspective. So you may have to give exposure to the rest of the business and or equity-like returns in order to achieve that.
Do you, and question to all panelists probably, do you expect that when we talk about litigation funding facilities that are sort of alike corporate facilities, when they are advanced to a law firm against all of its proceeds and sort of all of its cases, do you expect any competition from sort of the more traditional banking lenders or private equity type funds? And the question to Chris and Tom, have you seen have you considered this? Have you considered reaching out to those type of lenders, and if there is any interest there as well, and whether this would impact pricing?
Well, I'm happy to just step in quickly. I mean, I think, that's our hope for all businesses that we might be funding with equity-like funding. I mean, hopefully they get to a point like many firms are in the US, where it's 12% or cheaper financing. That's a good result for everyone involved. But it's a journey for the industry here in the UK and in Europe, and also for individual firms that may just have begun 4, 5, 6 years ago and are in the very early stage of building a portfolio and building a business. I think one of the challenges is what Chris mentioned earlier around flexibility, speed of action, being nimble. I struggle to see how HSBC, sorry if anyone from HSBC is here, would be able to do that.
Yeah. And I think,
Not Credit Suisse, definitely.
I think, I can talk from sort of how the legal practice has changed in the last few years, but, we do work in the US, and the cost of capital is cheaper there, but maybe the market's more progressed and people have more confidence. So you have seen a real shift in the courts of England and Wales, certainly, over the last 5 years. And I think once those relationships become more established, then you'll see different structuring. You will see the cost of capital come down. It's quite easy to sit here from a sort of being a solicitor and think about the clients and the firm, etc. But you have to see it from the funder's perspective too. It's justifiable and explainable why you might be looking at high multiples and returns of capital out now. And I'm then the secretary of CALA, so the Collective Lawyers Redress Association, and we've been speaking to funders recently and actually hearing their side of the coin as to actually, with better communication, with better access to data, what we sort of discussed earlier on, working progressively together over the next few years, you'll see insurance instruments coming into play, capital protection, all these mechanisms which may be more profound in the US will cross the pond, and I think you'll see an acceleration and a rapid maturement of this space here.
I mean, it's a more mature industry across the Atlantic. I mean, if you've mentioned the Redress Association, I mean, it's I don't want to say a new invention, but it's a relatively new trend in English litigation. And if you cross the pond, it's a much more established trend. So I think it's easier to say that a lot of the American claimant side firm are a lot more established in the sense that they have a track record. There's a panel here earlier talking about competition, appeal tribunal litigation. That is in its infancy. Nobody knows how it will end up, and the price, so that impacts the risk. That's obviously impacting the price of the capital. But if you are set in the US, where there's a body of jurisprudence and there's experience, obviously the risk is much lower, and the cost of the capital is respectfully also much lower. So I think most of what we see is a lot riskier than what our US colleagues see. So I'm not surprised that it's more expensive.
Yeah, and I think from the sort of the law firm perspective, or from the legal industry perspective, where you look at the emergence of new law firms entering the market, maybe with a US connection, coming in really, and I'm focusing more here on the group claims and perspective, you're going to see with those entrants to the market, there will be shifts and changes over the coming years. And I think from a funder perspective, they want to see how that plays out. I mean, that really impacts into sort of the long-term risks, and so I think it will be an interesting few years, but I think we won't be behind the US for too much longer.
Thank you. And just sort of zoom in on challenges, I guess one of the main challenges that we've seen, we've probably done 3 or 4 those law firm financing in the last year, and one of the main risks is insolvency of a law firm at the end of the day. And we looked with our funder clients into sort of what happens in practice, you know, when if the law firm does go insolvent, and what are the practical steps of assigning the book, and how much control a funder may have over this process, and sort of how this affects the pricing, and then sort of knowing all this, what protections you can put in place, for those very rare but quite important scenarios. So I just wanted to ask the funders how they sort of assess this risk and trying to mitigate this risk in their deals, and then ask Chris and Tom sort of what do you do on your side to sort of mitigate this risk as well?
I mean, I would even add to that also personnel risk. So we're not talking about enormous enterprises in many cases, and a few partners leave, or God forbid something happens to them. That's also a risk. Obviously, we're dealing with individuals that make a huge difference. I mean, it's tricky. You can get contractual protections. They'll only carry you that far. You'd hope that the cases are meritorious. And from a credit perspective, if the cases are meritorious, the assumption is that you can always have someone come in and continue, and as long as you have contractual protections, you can take them and treat them like any other distressed asset and move forward with another practitioner. I'm not sure that's a situation that anybody wants to be in, but that's a solution. I mean, I think, Alex, you'll be better suited to answer.
No, look, I don't disagree with that. Whether we're talking about law firms or other types of borrower, going through an insolvency process, administration, or whatever it might be, is always a lot more expensive and time intensive than you can possibly imagine, and not really what you want to do. You need to be ready for that scenario. Hopefully, the cases can be run by someone else or in a different structure. You also need to be able to fund through to completion, yourself, or to overfund the firm if it overspends. And it's part of the reason really why this is so expensive, because there's a cost of capital associated with the capital that you need to put aside when you're thinking about funding these claims, because you don't know if the settlement as projected is going to happen in the next 6 months, or whether you're going to go through trial, and you don't know if things might happen, other things might happen, such as something to one of the lawyers or the law firm that's dealing with the case, and you might have to step in and handle that yourself. So I think the contractual and the legal protections are one thing, but I think having a plan B, both in terms of funding and somebody else potentially handling the cases, is important as well.
I want to add something to that. There was a discussion in an earlier panel about the layers of appeal and how many trips the Court of Appeal, the Supreme Court have been taking. I mean, it's almost clear that delays are a tactic used by defendants knowing how cases and litigation is financed, because everybody from the funding side has agreed we are very sensitive to duration and how long things take, and that erodes a return and erodes a collateral and make everything very, very tricky, and also creates a little bit of bad faith because budgets get overspent and everything doesn't look as glamorous as it did day one. And from a defendant perspective, it's very easy to take a trip, I mean, it's not a trip, but a trip to the Supreme Court that takes you a year or two and costs you a little bit, but not as much as the pain and challenge that it inflicts on the other side, especially if the other side is thinly capitalized and relies on expensive financing to run the case. So it's a challenge, and again, you have to prepare for that, because that's eventually going to happen, and you have to price for that, which, again, impacts the cost of the capital.
I think from the law firm perspective, as our business has grown, we've introduced all of the measures that you would have in any typical structure: corporate governance, C-suite, de-risking key individuals throughout the business, ensuring that there is that succession plan. If someone was to be hit by a bus, and you have to plan for that to ensure the continuity of the business from day one. So I think those steps are natural. If you did find yourself, the solicitors always act with their client's best interests at heart, and are professionally obliged, obviously, to act in such a way that if you found the firm in a compromised position, then you would be proactively taking steps with the regulator for orderly transfer, with the sort of the contracts that are sitting behind, would be a key part of that. So I think the mechanisms exist. You do have to plan for the worst, but fingers crossed that doesn't happen to too many of us.
If I can just add, I think on the kind of credit side, on the solvency side, there's not much to add, but when you kind of look at the equity side, I think generally exit can be a difficult issue. Pools of cases are by their nature self-liquidating, but actually when you look at funds, private equity funds, others who've ended up with equity stakes, particularly in the UK, the IPO market's not buoyant necessarily as regards law firms, and actually kind of planning for how, if an exit is planned, how that could be affected and what that will look like can be a real challenge in getting some of these deals done as well.
And just to follow up on the insurance point, so obviously insurance is one of the alternatives to litigation funding. Do you feel, Chris and Tom, how this option is explored in the market? What's the trend there? Is it becoming more popular or not, or is it just sort of a share of a market? And sort of what are you seeing from Exton advisors when you're trying to sort of arrange a deal, and what are the asks coming in on this point?
Sure. Do you want me to go first?
Up to you, yeah.
Okay. I think we see insurance kind of playing two important roles when it comes to portfolios law firm financing. The first, and it's been probably mentioned a few times today, but is on the capital protection side. I think inherent in hedging principle, you're changing the risk-reward dynamics. You can move some of these portfolios closer to looking like assets, to being investment grade, and that has some important implications for the types of capital you can attract, the types of terms, and the type of transaction structures you can look to. The other area which I think is growing is the use of WIP insurance by law firms, particularly in the context of contingency fee portfolios and damage-based agreements. I think we are seeing more firms use DBA insurance programmatically and building up portfolios of cases which are insured and not necessarily funded in circumstances where liquidity isn't the primary issue. It's not the first challenge, although disbursements can be an issue. I think that's interesting because insurance can be cheaper, and it's actually, I think, enabling certain law firms to begin to compete with funders on a very similar equity stake and litigation basis, which could be quite exciting moving forward.
Yeah,
Do you think that, and obviously we don't have an insurer on the panel, but do you think insurance is as good on the payout as the funders are?
Oh, well, there's some insurers in the room who I think would be very angry with me if I said that they don't pay claims. Devil's in the detail in terms of what's being protected in policy wordings and what's being hedged and how those mechanisms work, particularly in the context of portfolios. But I think in our experience, the track record of claims paid is good. You're dealing with good insurers with typically very good credit ratings and risk. So that, there's no reason to see particular challenges there, at least as I see it.
No, I mean, there's not much more I could add to that. I mean, safe to say that more, if you just focus on, say, ATE, that will always be there. It will always feature. I think as some of these cases that certainly we progress and other group claimant firms enter the market, there will probably be some innovative ways to look at how to properly insure the cases from sort of the ATE perspective. We have Quox position sort of reverting as of in a week or so's time. The play of the need for sort of ATE is probably the only thing that I think that is probably relevant in the market now from Quox, but also the size of the cases that are being brought before the courts.
But do you see going forward insurance law firms using more insurance, whip insurance, as an alternative to funding? And obviously Pogust, Goodhead don't have to do that because they have such a lovely funder, but in general in the market.
I think so. I mean, we an interesting time in the market at the moment where everyone is trying to grow, and if you can have a liquidity event or money in or a protection which gets everyone comfortable or increases the capital at your disposal at any given time, you're going to see a lot of people wanting that product. There is a need for it, and I think perhaps in the next few years maybe it slows down, but right now I think there will be a demand. I can very much see the need from a lot of firms in the market.
I mean, what we have seen from the sidelines, though, is insurance used as a step towards financing. So instead of financing via a traditional litigation finance or a credit fund or a bank or whatever, you take your risk, you insure it, and you create this structural asset that has protection built into it. Once it has protection built into it, that it's insured by a credit-worthy insurance, you can then take it and borrow against it and so to speak, submit it or bring it up as collateral and borrow against an asset, quote unquote, that has insurance wrapping it. But at the end of the day, things cost, if not exactly the same, then pretty much the same, right? Because you have to pay for the insurance and you have to pay for the borrowing, and you've got to have a certain loan-to-value ratios to allow you to borrow against the asset. So it depends on how much money you need to get or to need to raise and how much rate you're willing to pay. And obviously if you have to pay for an upfront premium on the insurance, you need to finance that as well. So that goes into the pot as well. So it has been done, and it has been done here and in other jurisdictions in substantial amounts. It's an active market. But it's not, at the end of the day, once you factor in everything, it's not that much different for the equivalent risk. It's not much more different than a litigation finance solution or portfolio solution or law firm lending. I mean, there's no magic structure that makes the capital cheaper and de-risks everything. You can structure it like this, you can structure it like that. At some point, those things tend to get to parity. So if the risk is X and you can get a credit line, it will cost you a certain amount. And if you can create a synthetic line of credit via insurance, by the time you burden everything with all the expenses, it will likely cost you pretty much the same. Otherwise, there's enough clever people who would arbitrage between those two. Yeah. So I think it's a solution, and it definitely expands the opportunities that law firms and claimants have. But I don't think it's a magical device where you can make things look safer or de-risk things just by insuring them. I'm not sure if you guys agree on that.
No, I'd say the same. It's complementary, and I would say we need to be careful about nomenclature. We call it insurance, but fundamentally we might be talking about the same thing. It's probably more likely to provide leverage, and the other aspects of it are, what about working capital? What about disbursements? And finally, the insurance industry hasn't had a great time of it recently. So there will be losses for insurers as well, and those events result in premiums going up. So yeah, it has its place, and where you can arbitrage and get it cheaper, and lever some of the more attractive risks in the portfolio, then absolutely firms should be doing that.
Thank you. And just to wrap up, sort of last question, if 1 minute comment. What are sort of future trends do you expect to see in the market? For example, do you see more of those partnership style deals between funders and law firms, or more sort of development into portfolio and single case financing? And if there was like one thing that needs to be changed for those deals to be converted into to be completed, what would that be?
Again, it's a guess, not even an educated one, just a guess. I think with rates rising and kind of turbulence in markets broadly rising, I think we would see some players who dabble in law firm financing, litigation financing, exit, not in a negative way, but exit because they would be looking for other opportunities and that yield attractive returns, and they will leave, so to speak, legal financing to firms that are more specialized, whether it be litigation finance firms or more sophisticated players that do multiple things but have a litigation finance strategy or asset class. And I think it will see more specialization and less, how would I say politely, less visitors or less opportunistic financing in the market. That's my guess. That's right.
I think that's fair, and maybe the more unkind version of that is fewer tourists. You tend to see this in difficult markets as we have now. Even outside of litigation financing, a lot of people have retreated from Europe, where it's the best time to be here, because of the volatility in the markets. And I suspect, with all of the interest, there will be people doing this without having done the groundwork and without the expertise that will eventually retreat. I think a couple of other things we might see are secondaries really come to the fore. I think there are some interesting mature portfolios floating around. Some of them are toxic. Some of them are potentially interesting. There are good and bad reasons for them to be available. In some cases, there are firms that have just decided to focus on the US, for example. But in other cases, it's just hopeless litigations that are being punted around. So yeah, a few different things.
I can't disagree with that. I think from our point of view, I think we'll see evolution rather than revolution. I think there are law firms who are getting to grips with this for the first time, that are looking at new ways of doing things, and we might see more deals, we might see greater market penetration in the short term, but I'm not sure we'll see wholesale revolution in the types of structures we've talked about.
I completely agree. The ecosystem is changing. I think you're going to have more entrants to the market, but probably a more collaborative approach to looking at cases, either it's firms working together, even funds working together, funds having confidence to invest where others or have already invested, and so forth. So I see the market maturing, as I said, quite quickly over the next few years.
Thank you. Any questions from the audience? Yes. Let's wait for the mic, please. And please also introduce yourself so we get the context.
So I'm going to have to shout to everyone. It does now. Hello. James Cole. I'm an originator of claims and an ex-Brown Ruddock person. A question on the interface between debt and equity, because there's a lot of borrowing going on in this sort of fairly context-specific arena. We've seen some funders ask for ROFAs, and to go to Leo's point, there's a lot of novelty in this market. First question, I guess, is do portfolio funders ever seek ROFAs from their borrowers in terms of the fact that they've invested in this case knowledge? And the second, slightly cheekier question is, if the majority of your funding is being used to build huge books of claimants, who owns those claimants? Because we've seen funders certainly try and pass through subsequent attachment to the claimants, and that obviously has some ethical questions, certainly in the UK.
I think ROFRs are almost natural. I think this is still a relationship business. We always use the same example. It's too boring to repeat, but this is not a mortgage that you shop around and you get the cheapest rate available. And even with a mortgage, we can run an experiment and ask how many people have their mortgage with their local building society. Most people have it with Barclays and HSBC. You want a financing partner that is substantial and capable. So I think that's true about any financing. I think that's double true about financing that is really the intersection between debt and equity, very, very risky, very, very expensive. So that's a long and convoluted way of saying there's always a relationship here. ROFRs, even if they're not written down, are almost a natural extension, because why would you go elsewhere if you have a relationship that is working? And if it's not working, then a ROFR will not do you any good anyways. It's just an invitation to a fight. I'm not sure I'm capable or the right person to answer the ethical question. It is tricky. My guess, again, not an educated one, is that we will see the answer to that in a context of things going very, very poorly, and then it will be solved. But we have to wait.
I think it comes back to the point that Susan was making earlier about controls and champity, and if that's the angle that we're looking at, I think everyone here would say does not exist, and the funders are that's something that we want to make very, very clear. From the law firm perspective, the clients of the law firms, the solicitor-client relationship, is not compromised.
Yeah, I agree with Leeor 100%. You can write what you like, and we normally do in relation to ROFRs, but ultimately you have to be a good partner, be fair, be responsive, and it just makes sense for both sides to work together.
Any other questions? Good.
Hi, Lawrence McSweeney from Harbour. A question for Alex and Leeor, but picking up on a point that Tom raised, was about equity in law firms. And I was just curious as to, if you have taken equity in law firms, are you intending to hold that stake indefinitely? Or if not, how long are you looking to hold it for, and what a good exit strategy would look like for you? So
hypothetically, and I cannot comment on. We have taken equity in law firms. It's public knowledge, but we've announced it. But I don't want to go into the specifics of that particular situation. But in another situation, a hypothetical one, I think when you walk into the quote unquote marriage, you kind of figure out a way of how to dissolve it, and it depends on what the parties need and want, and you find a mechanism to buy people out. And it exists in most partnerships as well, right? The traditional law firm partnership will have a mechanism of buying partners out, and it's not that unusual or that complicated. I don't find it hard, unless I'm missing something.
I think what I find harder to believe is that people would actually want to partner with lawyers and simply avoid them.
Look, I think it's a simple put and a call that we would almost always enter into in any equity investment, because we might fall out in the future, and it's just a simpler way of dissolving it.
And we've heard now most important point on what men think when they walk into marriage.
I don't have a put and call there.
No, that doesn't work like that.
Any other questions? I think no. We're actually quite blinded here. So
there's a gentleman on the
yes.
right.
I don't have a microphone. I have a quick question. My name is Jonathan Reed. I'm a barrister. I've worked in investment banking before becoming a barrister. When I hear the word portfolio, the first thing that comes to me is build a big enough one that's diversified, tranche it up, and then distribute it down to people who have attractive, desire for different parts of the capital structure. So my question to the panel is this: You say that we're seeing evolution in the litigation finance space, which I entirely concur with. But Alex in particular might have a view of this because Northwall has a structured credit business as well. Are we going to see this business move towards more traditional structured credit solutions, including tranching, distribution of different parts of that risk to different potential end investors? Or is the market not going to evolve to that degree of maturity? Is it going to remain much more of a bespoke, alternative credit asset?
I think the short answer is yes. The slightly longer answer is we're away from that, because you need a product that's attractive enough for people to put in the most senior-most tranche of that cap structure. I think from our perspective, we'd be happy to take the junior-most tranche because, in a sense, if you believe in that portfolio, then whether you're in the senior part or the junior part, you should be in, relatively speaking, the same position. I think we're already seeing that. We've seen a couple of funders come to us about some of our positions and talk about putting in place a structure with a senior, a middle, and a junior part. Some people happy to take a much lower return for a lower leverage. Typically you think of hundreds of millions being the minimum size to do any kind of structured finance type transaction. I think that's a challenge here as well. How do you construct a portfolio that's large enough and easily understood enough by the market to do something like that? But I think it will happen.
If I may politely disagree not with your observations but with your conclusions on.
Okay.
I don't think so. I think what you're asking about is securitization. This is not a house view, this is my personal view. For a variety of reasons, the most important one is disclosure, which is very tricky if you're dealing with litigation. So the investors that you will tranche this up and slice it and sell it to them would want to know what you're selling, and you not always are in a position to disclose. So that's a very big obstacle. The second obstacle is size, which is it has to be big to warrant the cost associated with a structured finance product. And I think the third problem is there's no need for it. In traditional markets, mortgages, others, CLO, the securitization solves the need to raise more capital. Whereas in our industry, I think the problem is not capital, meaning if you have a meritorious claim, you will finance it. It's not hard. There's enough people who want to be active in this market, who have ample capital, who will finance it. So it doesn't solve any problem, maybe other than de-risking. Now, I do agree with Alex 100% that you see it in, so to speak, and there's a panel following us in so to speak, funder to funder, investor to investor, fund to fund discussions where people say, maybe we structure it a little bit different. I will take a piece of this that looks a little bit different than the piece you're holding, and the yield or the rate on that piece is different. That happens all the time. At least the discussions happen all the time. I'm not sure how many of those are actually come to fruition. But I don't think we'll see a public market. There are some examples in the US on a very small scale of trying to syndicate and so to speak securitize litigation finance. It's done on a semi-retail level, but it's very, very small.
I think maybe what I was thinking of more, and I think you're right when it comes to the sorts of claims that we typically deal with. But if you look at generic claims with thousands, if not hundreds of thousands of claimants, if you think about the Lionheart SPAC in the US,
sure. Not
a securitization, but because each of those is pretty much exactly the same, that is something that they were able to pull off. Obviously what happened eventually is more interesting than that, but unrelated.
Yeah.
Perfect. Well, I'm afraid we're out of time, so please join me in thanking this panel.
Thank you.